You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means we are back once again, a rare live treat. Time for a rare live huddle episode of Options Playbook Radio. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-compelling network upon which so many of you are binging these days. I see the bandwidth bills. I know how many of you are binging. I want to thank all of you out there for November, a ridiculous month by just about every metric that we have. And we've been doing this for some time. In January, it'll be 16 years, and November blows every other month we've ever done off the charts. Just ridiculous. So thanks to all of you out there who've been listening to OPR and everything else we do here on the network. We love you all. Of course, remember, if you do like what you hear, all we ask is you take a second to rate and review it on your platform of choice. It really clearly has an impact in this market right now. People are concerned. They want to learn about options and concepts like volatility and hedging and income and things like that. So what better show to do that with than OPR? So thanks to all of you out there who've taken the time to do that, just like Rosalia did here, leaving 5 stars in Apple Podcast. She just wrote, wow, in all caps. This is so wonderful, informative, well-organized, expert, fun, and so helpful. Hope I live long enough to digest each episode. Thank you. Thank you. Wow. Rosalia, thank you for taking the time to write such a wonderful review. We appreciate all of you out there. Remember, if you do like what you hear, you want to go above and beyond, you want more great content in your life. I just checked the other day on that pro podcast feed. We have now nearly 200 episodes of exclusive shows over there, including great pro Q&As with some of the best minds in the world of options and derivatives. If you want to check that out for yourselves, get live access to this, every other show we do here on the network. Of course, great giveaways. Just gave away the November Pro Trading Crate. If you're active in the month of December, you are automatically entered into the giveaway to win the December crate. Where can you go for all that fun and a whole bunch more? Theoptionsinsider.com/pro is the place to go. And now it is time for me to welcome on your regular host here on the old OPR, a.k.a. the options guy himself, Mr. Brian Overby. Mr. Overby, welcome back to your own show, sir.
Well, it's great to be back, Mark, and want to wish everybody a happy holidays. And here is our gift to you. Well, I should say we really are the receivers of the gifts of everything that has happened this year in Options Playbook Radio. But Mark and I are gonna huddle up, and we're gonna try to answer your listener questions. So here we go.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions@theoptionsinsider.com.
All right, welcome to the Huddle segment, I should say, the portion of the show where Brian and I huddle up to answer your questions. Before we even get to that, Brian, how great is Rosalie and the rest of the folks who take the time to leave those reviews? I didn't know your mother was active on Apple Podcasts, Brian. I've never heard so many superlatives in one review. Wow, that was impressive.
Yeah, that was impressive, and that is awesome. And I can't believe the numbers that we had in Options Playbook Radio. You were just talking about November on with all the podcasts, but just over the year, going to have over 2 million downloads, probably most likely, which will be a record for us. And that's just awesome news. And thanks to everyone for all the support that we get.
All right, let's keep that party rolling here. Let's go on out, Brian. Let's set the palate, a little appetizer, if you will. We just came off the Fed, and everyone's paying attention to this year. What a tumultuous year it has been. Up and down, volatility, then no volatility, everything seeming to hinge on the Fed. So we thought we'd take a fun tack for our question of the week this week, Brian. I'm curious to get your thoughts on it as well. It's very simple, but maybe deceptively simple question. We asked folks, which option strategy have you used the most in 2022? And if you don't see your favorite, write in with your suggestions. We've had a bunch of write-ins for a variety of things. Seems like straddles and strangles were popular write-ins. So maybe if we did this again, maybe we would add them in. Again, it's Twitter listeners. We're limited to 4. Here's the 4 we gave you. We gave you butterflies, condors, and spreads with wings, that ilk. Then we gave you long calls and call spreads, long puts and put spreads, and then flipping the script, short puts and put spreads. Brian, I'm curious for you. Maybe is one of these buckets fit for you, or maybe you have your own write-in you want to suggest? And then B, what do you think our audience is choosing for their option strategy they've used the most in 2022?
Well, my favorite trade is the butterfly, of course, but I have to say that I probably looked at more long call spreads and long put spreads. I guess it would be long call spreads. I guess it would be long call spreads. I talk about those more. It's harder to be bearish on a stock than it is to be bullish when you're trying to teach options. So a lot of the things are based on the bull side, even though we've had a tough market. Except for the tech stocks, we did do a few bull put spreads in Meta and a couple other of those type of stocks. But I'm going to say, gosh, I guess long call spread.
That's for the audience as well?
Well, yeah, I guess I'm assuming that they're just listening to my podcast, so they're basing it off of those trades.
Just mimicking your trades. That's all they're doing out there. I love it.
Right.
Uh-oh, getting to his head a little bit, the numbers here, listeners. All right, let's go see what you folks have on the brain. And right now, Brian, it's a hotly contested contest. You have a little over a day left, about 2 days left, listeners, to go play. At Options is the place to go if you want to play along. And right now, Brian, slight lead, 31.4% for short puts and put spreads right now. Does that surprise you?
No, it doesn't. Like I said, I mean, you're a put spread. So when you say short put and put spread, I guess that would be not a. See, I'm a little confused by the way that's worded. Because does that mean a long put spread when they say short put and put spread?
No, short put means you're just selling, the nearer at the money put and then buying a farther out of the money put, right?
So that's all that we're going to do.
That's all. We're keeping it simple.
So that's just meaning people that want credits in their account. So ideally, I'd have a comment on that. I mean, I really think that in this marketplace, buying premium is better than selling it. Just because we've actually had more realized volatility than what the VIX was implying. And it was just very weird to see the dichotomy on the way the VIX was. Most of the year, the VIX got it wrong and was low on volatility. But I understand with this type of volatility that people would be drawn to selling spreads as opposed to buying them. So the more I think about it, I've gone full circle. I think my answer would be short put spreads.
Yes. After I give you the results, you're lining up with them. I see how you're doing that there. But it makes sense to me. People are starting to nibble on some names that have been beaten up. They're going to use short puts to do that. So that makes a lot of sense to me. Right behind it, Brian, 29.4% is the long call and call spread. Then 23.5% for your choice, the butterfly, the condor, all the spreads with wings. And bringing up the rear, which is kind of surprising to me, given a year where it's been mostly down. You think this would have done better, but long puts and put spreads, no love. only 15.7%, Brian. So intriguing results. I must say so myself.
Without a doubt. I haven't done as many long put spreads in my podcast. I do them if anything, I was long put spreads on the tech stocks, and that's the only way that I would have traded them, actually, considering what happened.
Yeah, it was a challenging year if you tried to just get long index puts, because unless you did it very early on, that was a difficult trade to do this year. So interesting stuff here, listeners. You got to go about a day and a half left if you want to get out there at Options. Make your voice heard. Maybe you agree with Brian. Maybe you agree with our listeners. Maybe you want to write in something else. At Options is the place to go do that. Let's get on out to the questions, Brian. First, let's go to VKM. He's got the question that's on everybody's brain right now. Everyone's obsessed with this zero DTE explosion. He wants to know, has Brian played around with the zero DTE SPX options yet? And what is his favorite strategy to use with them? Brian, I don't think you and I have talked much about this. So let's start there. What are your thoughts on this just transformation of SPX into all 0 day all the time? And then B, what is your favorite strategy to use if you are doing so?
Well, it would be some type of spread. Actually, on last week's show, we talked about a long call spread that only that had basically 2 full days of trading, not 0 days. You're not doing it within a very, very short time frame. And those would be my favorite type of trades, where I'm going to be speculative on it. I'm in an expensive underlying like the SPX. You're selling an option contract that has a boatload of premium that has to go to zero. And that's what I've always looked at, even before these were invented. If I think about all the trades that we've done on Amazon, which Amazon always announces on a Thursday after the close. That means you got 1 day of trading all day Friday after that announcement. And for a lot of the same reasons, it was an expensive underlying. They obviously went through their split recently, and expensive underlying with 1 day remaining. And so it makes it very interesting to do butterfly trades, something that really wants time decay. And that would be, I guess the butterfly trade would even be, I was going to switch my answer again. I really sound like a politician up here, but I think I like the butterfly trade because you're selling 2 option contracts at the middle strike if you're doing a 1x2x1, and that means you have a boatload of time decay that you want to happen if you're correct on your forecast. Butterfly strategy.
All right. Yeah, a lot of people have been starting to play with those zero DTE butterflies, which on the surface sounds absurd, but when you start playing around with it a little more, it makes a little bit more sense. I think we'll have more questions about. In fact, we do. Our next question is right along the same line of daily expirations. This comes from Jake Matthews. He says, does Brian think we'll see daily options expand beyond SPX to other products like Apple or Meta? Asking for a friend who's not really an SPX guy. Thanks for making this show. It has a permanent home on my Pocket Cast. Well, thank you for listening. I'm a Pocket Cast guy myself, Jake, so glad to see you like it. It's an easy way to get your podcast across a bunch of different platforms, a bunch of different devices, Windows, Android, Apple, all that fun. So glad to see OPR. Hopefully the whole network does, but if you just like OPR, hey, we won't judge you out there. Brian, your fan here, Jake, wants to know, do you think we'll see these dailies expanding to products like Apple and Meta in the near future?
Yeah, I think that's the trend. As long as, Apple they have to have volume. Meta has volume, Apple has volume. You get down into a little bit, let's think of popular names like a Walmart. You get into some of those retail stocks that, I just don't want to see it. Is the thing is that we struggle sometimes with so many offerings, and the more and more offering, the harder it is to keep the bid asks of all the option contracts tight. So I think we're going to go that way on extremely volatile or extremely heavily traded stocks. I think Apple would be one of the first ones that you would see these in. And, but I don't know if I really want them. Am I going to get in trouble for that?
I think our listeners are going to want them. Yeah, right. It's an interesting prospect. I put this question back to John Davidson, the CEO over there at OCC, back at the OIC conference earlier this year when this daily stuff was just starting to percolate on the horizon there. And he kind of pushed back on it a little bit as well. Now he's coming at it from the clearing perspective, obviously. So he sees everything just through the lens of risk, which makes sense. That's his job. And SPX, they're okay with it because you're not going to get a crazy corporate action at the end of the day in SPX the way you are in a single name. You know, a single name could be acquired. There could be a surprise dividend. All sorts of weird corporate actions could happen. And now you have an expiration popping off every day on top of that. And it sounded like from talking to him that he was not overly keen on the idea of OCC going down that road and having to model all that risk on a daily basis for a bunch of names. I think given the volume numbers, it probably is inevitable at some point that we will see something. I think you're right. It's going to probably be limited to the Apples and, you know, your Teslas first, and then maybe the big volume leaders, and then maybe slowly it will matriculate. Whether it'll be this year or not, it didn't sound like that's the case. I think there's also a technological issue there with trying to get their risk modeling up to snuff and that quickly for these products. I don't know if they're quite there yet. So, Jake, I think eventually look at SPX. I mean, the amount of volume going up on the same day is blows everyone's mind. So there's clearly an interest. It's just whether the industry is ready to, behind the scenes to get. It doesn't sound like they are yet. So maybe by this time next year, we'll be talking about something coming online, like a pilot maybe in Apple, or you mentioned Meta, maybe one of those in early 2024. I just don't see it happening anytime soon. But then again, these last couple of years post-pandemic have been insane. I wouldn't be surprised by anything happening. It could be announced tomorrow, and it wouldn't surprise me at all. All right, let's go out to Jeddah. Jeddah wants to know, how and why did Brian become so enamored with the fig leaf strategy? All right, Brian, what is the origin story of the fig leaf? Not just the name, but also why did it become so firmly entrenched for you? What was it that captivated you about the fig leaf?
Well, I love the fact that Jeddah did use the correct name for the strategy. Some people incorrectly say leveraged covered call, but and I'm saying that with a smiley face. But ideally, the fig leaf strategy, well, it's not that I was enamored with it. I just drew attention to, or I shouldn't say it that way. It's not that it wasn't popular. I just drew attention to it by naming the strategy. So it was a very popular strategy for a long time, that in all the years that I've been trading options, but there just wasn't enough attention drawn to it because it's just a simple trade. If you think you would like to buy a stock, and I think this is like a great environment, and I've talked about it a lot. The most recent one I think we did on Options Playbook Radio, well, I think we talked about the SPYs, but on a stock was Caterpillar. We looked at, Caterpillar came out and basically said, we have, after their earnings, we have the demand, but we have supply chain constraints. The stock tanked. It didn't say that there's anything wrong with the business, but the markets just were spooked. And in that scenario, you have a fairly expensive underlying. Why not buy a deeper in the money leap option as an alternative to owning that stock, limiting your risk, and still kind of a fear of missing out, still have that upside opportunity in a stock like a great industrial like Caterpillar. One of the biggest things about it, though, is that you need tighter bid-ask spreads. And as more and more people come into the marketplace, and specifically around earnings, you can sometimes get better fills on those type of underlines. So now you have something that looks like the stock. Why not sell a call against it? Now, my whole thing with the fig leaf and where it came from is that you're kind of covered. And as far as the brokerage firm is concerned, you're covered. You have the right to buy the stock at a lower strike price than your obligation is to sell the stock. Now, we have different expirations. But the biggest thing is the person that's going down the road of doing this strategy that owns stock and have done some covered calls, this is the next step. And the process, if you get assigned, is not that straightforward, right, with the fig leaf, because I have this thing that acts like the stock, but it's not the stock. And if I get assigned on the short call, well, now I got to get the stock. How do I get the stock? Do I exercise the call? Do I just sell the option and then go out and buy the stock? I mean, so we like to say you're kind of covered. And that's where the fig leaf came from. And as with all the different innuendos in option trading, like naked call writing, naked put writing, spread straddle, we just thought we'd toss in the fig leaf. And and I thought it fit well because that is the tagline that you can find if you look at the very last paragraph of the fig leaf strategy. You will find that tagline. We like to call it a fig leaf because you're kind of covered. And it was a strategy that was deserved to be named, and it wasn't getting the respect that it deserved. So we gave it that respect. And thanks for your question. And I can shut up now.
Give it the respect it deserved, even though the cool kids call it a synthetic covered call, right, Brian?
Well, leverage covered call. Synthetic actually isn't there because synthetic would imply that you have the exact same risk.
You're right. Levered covered call. I've heard it called synthetic. Poor man's covered call.
I have heard it called that. I've heard that before.
Poor man's covered call. Absolutely crazy cakes position that no one should trade. All sorts of names have been leaped upon the fig leaf out there. I'm kidding. I love the fig leaf. I'm a fan of it as well. Let's go on out to Kennedy. Oh, this is just what we were just talking about, Brian. Kennedy says, does the host think that this was a good year for SPY put traders? Does he have any recommendations for those of us looking to hedge next year without losing our shirts? We were just talking about this, Brian, and I think you'll agree it was a challenging year for SPX and SPY put traders. Unless you had that hedge on early and you kind of caught the aggressive downside move, which is what you really need to make puts pay off. Unless you had them on for that very limited window, the rest of this year was a challenging time to just buy puts and make money. Would you concur, sir?
Yes. But ideally, this is one of the things is I thought the puts were underpriced for most of the year. And, the historical numbers kind of show that, especially in the heading into September and October. The VIX just was not spiking at all. And so, yes, I think it was a challenge, and it always is. And when you got the VIX above 20%, just period. But ideally, you kind of got a discount on a lot of those puts. And should I go on to the next one? I mean, I'll pause for your thoughts on that, on my comments, Mark.
Interesting year. I mean, you think they were cheap compared to realized vol? Is that how you're looking at it?
Yeah. So if you're just looking at it in a vacuum, the market in general was more volatile than what the VIX was implying. And that usually means that buying puts was the right thing to do, as opposed to the opposite side where you were just flat out a seller in a vacuum.
Yeah, this is an interesting year for that. There were some periods there where, from a skew perspective, those puts were still getting kind of pricey. So that's what made it doubly challenging for people, because they were paying this exorbitant premium on top of what they already was being priced into the market from a vol perspective. You already had this put skew in some of these indices. So if you were paying at the high levels of skew, that made it doubly challenging to make those puts pay off, right, Brian?
Yeah. And there are going to be moments. I'm trying to make it general, and I guess there's really nothing that's general when you look at volatility, right? It's really hard to try to make a generalization about it. But, the second half here, do we have any recommendations on hedging? One of the things that a lot of people don't think about is, if you just buy puts outright, you are insuring yourself from wherever that put strike is all the way down to zero. So if I'm talking about, in particular, SPY or SPX puts, I'm always thinking about doing a put spread. Even if I'm going, let's say, 25% below where the market is at, which would be bear market territory, right? I would be still buying something closer to where the market is at, selling something 20, 15% out, and I'm trying to do it for the first 2 months. I don't want to go too far out in time, just because if the market does rally, then your put spread doesn't help you that much and you got to adjust it. So I'm always looking at 1 month to 2 months out maximum if I'm looking at SPX, and I almost always think a long put spread as a protective trade. So that's the way that I always would look at it, as opposed to just buying puts outright.
Yeah, I'm very rarely would ever come out and say, hey, just load up on out of the money puts. You always have to have some sort of short leg against it for all the reasons that we just outlined here. That's a very challenging trade, and you're going to pay a lot for that. So you have to have some sort of short leg against it, whether it's a put spread, whether it's some sort of collar with a put spread kicker, all sorts of ways you can construct it. But as long as you have some sort of short leg against it to mitigate your outlay, because a lot of times with these puts, that outlay is going to come back to bite you, and you need to take steps to be proactive to mitigate that along the way. So that would definitely be my thoughts. If you want to hedge next year and you are worried about not losing your shirt, as you put it, then yes, definitely some sort of put spread leg against it. There's many different ways you could play with that. There are entire segments of the industry that spend their whole day, every day, just looking for ways to pay for puts. And there is volume of research on it. We've done many episodes. This show, Option Block, Uncle Mike in his strategy block has talked about it a bunch of times. Options Bootcamp show, we've talked about it. Tons of research out there. Most of it ends up coming along the lines of pushing your hedge a little bit farther out, maybe somewhere in that 3 month plus, maybe out to 6 months. That's a long time in the index, though. So somewhere probably I'd be closer and more comfortable with around 3 months, and then migrating your short premium closer to the expiration front. Now with dailies, you can do it almost daily out there, and then taking advantage of that theta on both sides of the spectrum there is the best way to kind of mitigate that. But again, you have to be judicious with the short premium legs there too. If something crazy happens and the market sells off aggressively, you're going to get caught. So be quick on the trigger finger with that short premium. But you have to have something. You have to have something that's going to offset your outlay. Otherwise, you're in for a lot of premium with maybe not a lot of bang for that buck. Speaking of, we had Kennedy just asking about next year. Let's go out to the Beeve. I like that handle, the Beeve. The Beeve wants to know, what is Mr. Overby's trading resolution for the new year? I guess it is that time of year, Mr. Overby. It's that time to look ahead and to set our calendars and to announce our resolution. So if you have one, sir, what is your trading resolution for next year?
Trading resolution for next year is to stay the course and not get spooked. So, in the first quarter, I think it's going to be a very scary quarter, especially if we see some unemployment coming into the marketplace. We're at 3.7%. I remember back in the day when we were at 5% unemployment, that was considered great. The Fed kind of wants to get back to that number. And so I think the biggest thing about next year is staying the course, knowing what your outlook is specifically in your retirement accounts, because it could get nerve-wracking in the first and second quarter of next year. Now, as far as my option trading is concerned, I'm going to just keep doing what I'm doing. I enjoy the outlook of the market and making a plan and following through with that plan. But I am nervous about what people are going to do after we kind of hope, I guess we're not in the Santa Claus rally scenario, but, the SPX at 4,000. Around 4,000 going into the end of the year is a little bit inflated, actually, considering the chances of recession at this point in time.
It does seem like a lot of people are pointing to Q1, early Q2 of next year being a very challenging period, as you put it. So people are expecting earnings to be terrible, really maybe start seeing the rubber hit the road in terms of all the negative outlook, negative headlines that people have been anticipating for quite some time. Maybe a lot of that coming home to roost in Q1, early Q2 of next year. Brian, I'm going to make a trading resolution as well. Since you had to do it, I will do it as well. I will not make you do it alone.
Awesome.
And we've been talking all show long about zero DTE stuff, right? So I think if I have a trading resolution, it's going to be, I need to play in those more. I need to explore those more. I need to see what's going up out there and explore how different strategies perform in that zero DTE environment. And also, I'm very curious because remember, Brian, when we had the big shift from monthlies to weeklies, doesn't seem like it was that long ago. It was close to a decade ago now. There was a big impact on how the monthlies performed as a result, because all this volume got siphoned off into the weeklies and the monthlies started performing a little bit differently as a result. I will also be curious to look into what impact this massive shift into everything happening single day, what impact does this have? Not just on the monthlies, but on the weeklies and the other dailies around it, right? This is kind of unknown territory. We're heading into uncharted waters, Brian. So I think exploring that more and all this zero DTE phenomenon from all different sides and dipping my toes into it more. That'll be my New Year's resolution. How's that sound?
Yeah, that sounds wonderful. I love it. I love it. And I guess I'll explore it a little bit more also. But I kind of have done that. I've always gone, and I mentioned, Amazon. Gosh, we do a Amazon earnings trade almost every quarter. And it's mainly because they've got one day to live, and they always announce on a Thursday of that earnings week. So, I find it very, very interesting, the dynamics of a one-day option contract and how gamma and theta work with each other, and et cetera, et cetera.
Yeah, it's funny to me because when I first got on the floor, you ran screaming from expiration most of the times because the systems just couldn't keep up. They couldn't model the theta. They couldn't model the gamma. Everything was just exponential. And you just got the heck out of Dodge because, there were opportunities there, but more often than not, there were headaches and problems along the way. So you kind of avoided expiration. And now it's kind of funny to me that the entire industry is running towards it with both arms to embrace it. It just cracks me up how much has changed over the years, Brian. It's intriguing, the stuff. Let's go out to the live really quickly, Brian. We've got some people in there that are having fun, including Age of Del Aquarius. He's one of our pro listeners. He says, this is my first live OPR. So he's excited, Brian. He gets to hear you live for the first time. It's like hearing Santa Claus live on the network for the first time. Yeah,
I'm excited too.
It's fun. It's fun. So we like, it's hard to get Brian to go live. We try to get him out here every now and then so you folks can get some live access to him. And it's always fun for the folks to hear you. They know you are a real person, not a robot now, Brian. We didn't just create some AI and call it Brian Overby and have it go host OPR for hundreds of episodes out there. All right, let's go.
I'd be up for that. Can I go to the Caribbean while that happens?
We'll see.
Right.
We'll see. AI is coming for us all at the end of the day, right, Brian?
Yeah, that's true.
All right, let's not hasten it. Let's go out to this one instead from Luigi, my boy Luigi, one of our other pro members. This is a fun one. He says, I've heard a lot of buzz that we are in more of a stock pickers market right now. I have always held the mindset that you should trade what you know and speculate on what you don't. Do you feel that this is where we are? Should I approach options with that same mindset? So a couple of moving parts here, Brian. First off, he wants to know do you agree that we're in more of a stock pickers market right now? And then he says you should trade what you know and speculate on what you don't. Should he approach his options trading with that same mindset, sir? Two-parter.
Right. Speculate on what you don't. Yeah, I don't mind to speculate on what you don't. So let's start there. Option. It's really, I do so many shows over a week, and it's hard to just do them all on the same underlying, right? So you got to change it up a little bit. So a lot of times I'll just speculate on something that's in the news, something that we mentioned on the show, Caterpillar. I don't think I have it in any portfolios, but that was in the news. They were coming out. All the things were indicating what was going on in the industrial space, that was going to be an interesting earnings. So we did a FOMO trade, fear of missing out. We did it more as a long-term trade, but I would be much more apt to do that trade again on a stock like Caterpillar around earnings, because the options market space is there. I might not have done that trade if I was just buying the stock outright at that point in time. It was a couple of earnings ago, just because the market was really scary, and it's that simple. So Yes, I think speculate on what you don't. I agree with that. And then as far as a stock pickers market, I kind of think you're just always in a stock pickers market. I guess if you go into the crypto space and you go into the meme stocks, which nobody's talking about anymore, if you're talking about, I guess that would be the alternative to a stock pickers market, right? If you're looking at those type of stocks, and I just don't ever want to be in that space anyways. As the Warren Buffett quote is, it really applies to crypto that you don't know who's swimming naked until the tide goes out, quote unquote, Mr. Buffett. But crypto really proved to be that case. And, in that crypto space, I think there's still more to come. Everything's still got to flush itself out to see exactly what's going on in that space now as people are running for the hills. I think, that's a scary space to be in.
Yeah, Mr. Overby, I think we have a title for the episode, Swimming Naked with Brian Overby. What do you think, huh? Good. I think your compliance will love it.
Warren Buffett. That's Warren Buffett's quote. I can't take the Oracle's quote from him because, I think I heard it again when it came back up with the FTX debacle. That quote came up again, yes. But what a wonderful way to look at it, because it is very true. When markets go down, that usually shakes out one or two players. You don't know exactly what space it's in, but it's going to be highlighted sooner rather than later.
I still like Swimming Naked with Brian Overby. I think that's a good title. I think everyone can get behind it. But Brian, that music means we have come to the end of another huddle, probably our final huddle for 2022. So we'll be back in January. Don't worry, listeners, with a whole bunch of more fun huddles. And Brian will be FOMOing it like crazy. Don't you worry here in January. But before we go, Brian, if you want to leave folks with any fun thoughts or ideas here for our final live episode of the year, have at it.
Oh, man. Well, just have fun. Take some time off. Enjoy. Get your portfolio in order. Use some covered call selling. I like to do that. I've talked about that a couple of times in the month of December. And have some happy holidays. And we will see you in the new year. Until then, may all the options you bought in finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.